The economy is never constant, and more often than not, it can be difficult to predict what lies ahead. But that doesn't mean we have to be caught off guard when the next recession hits. If you're like most people, you're probably worried about another recession hitting us sooner or later. But here's the good news. Jim Rickards has some great advice for those of us concerned about our finances. He is an expert in finance and has helped many people safeguard themselves against economic turmoil. In this video, he'll reveal not one, but two must-have assets that will help keep your wealth secure even in tough economic times. The current financial crisis. It's quite clear that a financial crisis is already in motion, as evidenced by the recent bank crashes. We've witnessed the unfortunate downfall of Silicon Valley Bank and Signature Bank. These banks, though the first to succumb, are just like the tip of the iceberg. You see, many banks in the United States have been taking on excessive risk and practicing poor risk management. It's not just about these individual banks, it's a pervasive issue within the banking system. In the coming months, we can expect more banks to falter, adding to the growing crisis. The recent bank crashes should serve as a wake-up call about the state of risk management in the U.S. banking sector. Poor risk management practices and the propensity for excessive risk-taking have put many banks at risk. Currently, banks such as the First Republic Bank, Huntington Bank, KeyCorp Bank, Bank of America, and Truist Financial are hovering above liquidity risk. Silicon Valley Bank and Signature Bank might just be the first casualties, but others are likely to follow suit. The financial system is facing a significant challenge that extends beyond individual banks and requires our attention. The risk of additional bank failures looms large on the horizon. The situation with Silicon Valley Bank is indicative of what the entire economy is facing. While the Federal Reserve stepped in to guarantee the deposits in that particular case, the underlying problem of excessive debt creation persists. It's not just one or two banks, it's a systemic issue. The consequences of this crisis will likely ripple through the financial landscape, impacting individuals, businesses, and the overall economy. Inflation and its causes. Inflation can arise from both the demand and supply sides of the economy. On the demand side, when consumer spending increases and exceeds the capacity of the economy to produce goods and services, it leads to an increase in prices. This phenomenon is often fueled by sectors such as increased consumer confidence, excessive government spending, or loose monetary policies. On the supply side, inflation can be caused by disruptions in the production and distribution of essential resources, such as oil or agricultural products. The ongoing Russia-Ukraine war has had far-reaching consequences, one of which is a shortage of oil. The scarcity has a ripple effect throughout the global economy, particularly impacting food and energy prices. With higher fuel costs, transportation becomes more expensive, leading to increased production costs and subsequent higher prices for goods and services. The interplay between geopolitical conflicts and the inflationary pressures cannot be ignored, as they contribute to the economic landscape we find ourselves in today. The surge in inflation brings with it significant challenges for businesses and consumers alike. However, fuel costs have a direct impact on production processes, making it more expensive for companies to manufacture and distribute goods. As a result, these increased costs are often passed on to consumers in the form of higher prices. This inflationary pressure can strain household budgets and erode purchasing power, potentially affecting our overall financial ability and stability. The severity of the current inflationary environment is evidenced by the staggering numbers we've witnessed in 2023. In fact, inflation rates have reached their highest levels in over 40 years. This surge in prices across various sectors of the economy has raised concerns about the long-term implications on our financial well-being. The impact on the economy. When inflation starts to soar, panic buying becomes the name of the game. People rush to stock up on goods, fearing that prices will continue to skyrocket. But here's the kicker. This surge in demand puts immense strain on the supply chain, exacerbating the problem even further. And guess what? When supply struggles to keep up with demand, prices continue their upward climb. To tackle demand-side inflation, the government often resorts to raising interest rates. By doing so, they aim to discourage excessive borrowing and spending. It's like tapping the brakes on an overheating economy. However, there's a trade-off. Higher interest rates make it more expensive to borrow money, limiting the purchasing power of consumers. And that brings us to the next domino in the chain. When borrowing becomes costlier, businesses find it harder to expand, invest, or even stay afloat. As a result, layoffs become a painful reality, unemployment rates rise, and the overall economic landscape takes a hit. It's a vicious cycle that leads to reduced consumer spending, less economic activity, and a decline in the overall health of the economy. The dollar's vulnerability. Over the years, the US dollar has held a dominant position as the world's reserve currency. However, this long-standing status is now being threatened. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively collaborating on the development of a payment plan that could potentially rival the dollar. This move signifies a shift in global economic dynamics as these emerging economies seek to reduce their reliance on the dollar and establish alternative financial mechanisms. The vulnerability of the US dollar has been further exacerbated by poor decisions made by the Federal Reserve. In recent times, the Fed's policies have raised concerns among international investors and central banks. Actions such as maintaining low interest rates for an extended period and engaging in large-scale bond buying programs have weakened the dollar's position. These measures have eroded confidence in the currency, leading to a reassessment of its long-term stability. Another contributing factor to the dollar's vulnerability lies in the US government policies, particularly excessive money printing. In response to economic challenges, the government has resorted to increasing the money supply, which can have inflationary effects. This, in turn, diminishes the purchasing power of the dollar both domestically and internationally. As global investors seek alternatives, the dollar's value relative to other currencies becomes more uncertain, posing risks to its reserve currency status. The vulnerability of the US dollar carries significant implications for the global economy. A weakened dollar can lead to a loss of confidence in international markets and increased volatility in currency exchange rates. As the world's reserve currency, the dollar plays a crucial role in facilitating global trade and financial transactions. Any disruption to its stability can have far-reaching consequences, affecting not only the United States, but also economies worldwide. Enjoying this video? Give it a thumbs up and share it with your friends and loved ones. Don't forget to subscribe and hit that notification bell to stay updated with our latest content. Now, let's jump right back in. Protecting yourself financially. One of the key aspects of safeguarding your financial well-being during a recession is to focus on long-term investment goals. It's easy to get caught up in short-term fluctuations and panic selling. However, successful investors understand the importance of staying committed to their long-term strategies. By maintaining a diversified portfolio and having a clear investment plan, individuals can weather the storm and position themselves for future growth. Throughout the history, we've witnessed remarkable individuals who have thrived during economic downturns. Warren Buffett, the legendary investor, is a prime example. During times of market turmoil, he has consistently demonstrated the value of staying calm and focusing on long-term value investing. Similarly, Robert Kiyosaki, the renowned author and entrepreneur, emphasizes the significance of financial education and strategic investments. Now, let's talk about the anticipated liquidity crisis. According to financial expert Jim Rickards, we're facing a unique situation where various assets, including stocks, bonds, and even banks, are predicted to crash. Jim Rickards warns that a liquidity crisis can result in severe market disruptions. And that is when a loss of confidence is in traditional financial institutions. Understanding this outlook is essential for investors to adapt their strategies and protect their wealth during these challenging times. Investing in precious metals. When it comes to investing during uncertain times, gold and silver shine as assets with intrinsic value. Unlike fiat currencies that are subject to government policies and economic fluctuations, gold and silver have stood the test of time as real money. These precious metals hold inherent worth and have been regarded as stores of value throughout history. Investing in gold and silver provides a tangible means to preserve wealth and protect against the erosion of purchasing power. One fascinating aspect of investing in gold is its inverse relationship with the value of the dollar. When the dollar experiences a decline, the price of gold tends to rise. This phenomenon occurs because gold is seen as a safe haven during times of economic uncertainty. As investors seek to protect their wealth from potential currency devaluation, they turn to gold as a reliable store of value. As we approach the potential recession in December of 2023, accumulating gold and silver can act as a safeguard against the impending crash. These precious metals have a long history of retaining value and even appreciating during economic downturns. The strategy offers a level of protection and helps mitigate potential losses during turbulent times. While gold bullion is often recommended as a solid investment, silver presents a more accessible alternative for many investors. With a lower price point compared to gold, silver provides an opportunity for individuals with different budget ranges to participate in the precious metals market. Silver possesses its own unique qualities and has applications in various industries, which can impact its demand and potential future value. So even if gold seems out of reach for some, considering silver as part of your investment strategy can still provide exposure to the stability and growth potential of precious metals. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.